Hello everyone, let's start our today's discussion. I hope you all remember that in our previous class, we had an introductory discussion about our advanced taxation course. In our today's class, we will be moving forward and we will be starting discussion on our first chapter of this course, and this chapter is Basic Income Tax Calculation of Individuals. But before going in detail of this chapter, let's take a quick review of what we discussed in the previous introductory class of our advanced taxation course. Now, if you all remember, in the previous class, we had discussion about some important things about this course. First of all, we discussed that why someone should opt advanced taxation in their optional level exam. We looked at good pass rates of this exam, additional exemptions we get in ICAW, its practical relevance, and the freelancing opportunities once you are done with this course. Then we had a discussion about the overall structure of this paper, like the theoretical and the practical aspect in this examination. We looked at the paper structure, including the technical marks and the professional skill marks. So these all things were discussed in detail in the previous class. The basic idea of the introductory class was to give you an awareness at what exam you are going to study and why it is one of the essential exam in the ACCA optional level exam. We looked at time allocation approach for planning in your examination, because you all know that my approach is very much exam relevant, and this is the reason why more than 50 of my students have secured nationwide positions in this exam, which is obviously, I would say, one of the great achievement, and I believe there is no other teacher in the market with so many nationwide positions. Then we had a discussion about the course outline, that what exactly we'll be looking at this in this course. And the first chapter, which we are starting from our today's class, is Basic Income Tax Return, which we'll be looking from our today's class. Then we had a discussion about the study approach and the study resources which we'll be using. So now today is the first class of the first chapter, first class of our studies, because the previous one was an introductory class. So this first chapter is Basic Income Tax Calculation of Individuals. See, our advanced taxation course is majorly divided in two sections. One section is individuals taxation and another is corporate taxes. We are starting with the individual taxation. Individual, the taxation of human beings. Corporate is taxation of companies. Now, in the taxation of individuals, the first chapter which we are studying is Basic Income Tax Calculation. Basically, here we will be looking at how an income tax return is made up of individuals. Whatever income you earn during an entire tax year, please listen to me carefully. See, my approach is teaching from very basic, very scratch, and in a lot of detail. Only thing important is your patience and concentration. Okay, so now we are going in detail of this chapter. So whatever income an individual earns during a tax year, that entire income becomes subject to income tax. So what the tax rates are, how we classify the income in different heads, because each head is its own tax rates. What is the tax here in UK? So this all we'll be discussing in our today's class. And since it is the first class in which you are studying advanced taxation, so maybe it will take some time for you to get familiarized with me, to get connected with me. But my approach is very much detailed. I will only teach this one column, and then I will be doing the practice questions with you guys. We will be solving the practice questions so that you get an idea. In every class, this will be my approach. Some concept and then practice. Some concept and then practice so that you can apply it. Okay? So let's look at it. Please listen to me carefully. So whatever income an individual earns during a tax year, it is divided in three heads for the tax purposes. The first head is non-saving income, which we call as normal income head. In this head, all incomes are included, except interest income, which is put in the head of saving income, and dividend income, which is put in the head of dividend. Now, there are some questions in your mind. Sir, what is a tax year? Why incomes are divided in three heads? Like, for example, you are earning employment income, doing a job, getting rentals, earning property income, doing some business, getting trading income, getting some returns from a pension fund. So you can earn a lot of incomes. During a tax year, Now, what is the tax year in UK? Tax year in UK starts on 6th of April every year. Listen to me carefully. Tax year in UK starts on 6th of April every year and it ends on 5th of April. So the tax year of UK is 6th April to 5th April, like 6th April 2024 to 5th April 2025. Then 6th April 2025 to 5th April 2026. So this is how from 6th April to 5th April. For our examination purpose, to create the ease, the examiner has said that instead of saying 6th April to 5th April, and even in your calculation, you can use 1st April to 31st March. Like you can round off the 5 days. You can ignore 5 days income. The real tax year runs from 6th April to 5th April. But in the exam, to make it easy, we write it as 1st April to 31st March. Because if we move back 5 days, so it's 1st April to 31st March. So whatever income we earn during a tax year, salary, which can be your employment income, or business income like trading income or rental income, whatever income you earn, or some interest income or some dividends, whatever incomes you earn during a tax year, write them down. Okay, the tax year is from 6th April to 5th of April. The current course which we are studying is Finance Act 2025. Please listen to me carefully. The current course which we are studying is Finance Act 2025. I told in the previous class also. Finance Act 2025 means tax year of 6th of April 2025 to 5th of April 2026. Repeat with me, say with me, 6th of April 2025 to 5th of April 2026. We call it as a tax year of 25-26. And it is relevant for the exams in June 26, September 26, December 26, and March 27. Now, some smart kids will message me, sir, tax year 25-26 ends on 5th of April 2026. Why are we using it in the exam of June 26, in exam of September 26, in exam of December 26? Because always remember, when the tax year will end, then only the tax filings will start. Tax return is filed after the end of the year. First you earn, then you file the return. So the tax year ends on 5th of April 2026. It is examinable for your exam attempts of June 26, September 26, December 26, and March 27. Okay. So income earned by an individual during a tax year, which is 6th April to 5th April, are divided in 3 heads. Because all of these 3 heads have different rates of taxation, we will study each and everything. Head number 1 is non-saving income, which includes all incomes, except interest income. It has its own tax rates. Interest income has separate tax rates, and dividend income has separate tax rates. Otherwise, all other incomes are normal incomes and they are part of non-saving income. So in the tax return, there are 3 columns: non-saving, the normal income head; saving income, the interest income head; and the dividend income, the profit distributions which we are getting. Non-saving income, which is the normal income head; saving income, which is the interest income head; and the dividend income head, the profit distributions which we are getting. So whatever incomes which you earn during a tax year starts on 6th of April, ends on 5th of April. Every year you have to make the return. Whatever income you earn during a tax year, you put that income in 3 heads: non-saving, which is normal income; saving income, which is interest income; and the dividend income. Now, employment income is non-saving, trading income is non-saving, property income, the rental income is non-saving. We will study each of them as a separate chapter. So don't worry, just listen to me carefully. REIT means Real Estate Investment Trust. REIT means Real Estate Investment Trust income. We will study this concept ahead. So don't worry. We will study it in our today's class only, REIT. Okay. Then there are trust incomes where you are a beneficiary. It can be non-saving, saving or dividend in some cases. We will study that in the future classes. For now, don't worry. Just I'm making a chart. Just making you a pro forma. Don't worry. Pension income, if you are getting returns from a pension fund. Interest income goes in the head of saving and dividend income goes in the head of dividend. Sir, what is trust income? What is REIT income? What is pension? I cannot understand. What are you doing? My friend, today is the first class. Don't rush. Patience. Patience. It's just a pro forma. Just to give you an idea that how a tax return looks like. Okay. Like it's a long chapter. There are so many pages in this chapter. Okay. It's just today's class when we are starting. So I'm just giving you an idea. Whatever incomes we earn during a tax year, we divide them in three heads. Non-saving, which is the head of normal income. All incomes are non-saving incomes, except interest income and dividend income. Then, sir, what about trust income? Trust has different natures. We will study them in the future. So don't worry. Employment, trading, rental income, REIT, pension, trust, all in the non-saving column. If you are getting interest income from the bank, that goes in the saving income. If you are getting dividends, that goes in the head of dividend. You add up them, you arrive at the value of the total income. Then there is a value called as personal allowance. Certain amount of your income is not subject to tax. That is waived off from the tax. Certain amount of your income is not subject to tax. That is called as your personal allowance. This personal allowance is 12,570 pounds. Whatever your total income is, from that 12,570 pounds just excluded. There is no tax on it. So you get the taxable income. On the taxable income, you will charge tax. Now you will have questions in your mind. Sir, can we deduct personal allowance from saving or dividend? Yes, we can. The total is 12,570. It is your choice that how you have to use it. We will study a complete topic in this chapter only. How to do planning of personal allowance. Everything will become clear only if you go with patience and concentration. On the taxable income, we apply the tax rates. Okay. Now, what are the tax rates? On starting 37,700, which we call as basic rate band, the rate of tax is 20% for non-saving. Sir, what about saving and dividend? Patience. Patience. We will study. We have just started. From 37,701 to 125,140, we call as higher rate band, the rate of tax is 40%. For example, if you have taxable income of 50,000, first 37,700 at 20% and then the excess goes at 40%. After 125,140, it's additional rate band and the rate of tax increases to 45%. Personal allowance is 12,570. Okay. And the tax year of UK, which we just discussed, it is from 6th April to 5th of April. This course which I am teaching you is Finance Act 25. Starts on 6th of April 25 and ends on 5th of April 26, which we call as tax year of 25-26. 6th April 2025 to 5th April 2026, tax year of 2025-26. Relevant for exams in June, September and December 26 and March 27. Basically, the tax filings of 25-26 will go on till start of 2027. In the examination, we can round off 5 days and we can write it as 1st April to 31st March for our ease, to make the things easier for us. Sir, please repeat it again. No need to say me. I will always repeat it again and again. Okay, and when we'll do the practice questions, it will get more crystal clear. So whatever incomes an individual earn, say with me, whatever incomes an individual earn during a tax year, which is from 6th April to 5th of April, you earn during a tax year, those incomes are divided in 3 heads. Non-saving, the normal income head. It includes all of your incomes except interest. It has its own head, saving income, and dividend. It has its own head of dividend income. The objective of dividing the income in three heads is because all of these three heads have their own rates of taxation. Okay, today we are talking about the non-saving, and in non-saving also we have just started it. We have kick-started it. Employment, trading, property, real estate investment trust, trust incomes, pension income, these all are detailed discussions which we'll be doing. Interest income goes in saving, dividend goes in the head of dividend. You add up all of the incomes to arrive at the value of total income. You deduct your personal allowance, £12,570. Always from non-saving income first because it has the highest tax rates. Once you will study saving and dividend, you will understand it. You get the taxable income on which you apply the tax rate. This personal allowance and these tax rates, listen to me, very important thing. This personal allowance and these tax rates will be provided in your exam paper. So no need to learn them. In the exam paper, there is a document called as tax rate sheet. In the examination, there is a document called as tax rate sheet. In that, this personal allowance, these tax bands, these rates, and a lot of other data is available, which you will be studying in your course. So I will be telling that, okay, this will be available in the tax rate sheet. And your tax year is from 6th of April to 5th of April. We studied some of this discussion. Now, just listen to me. Whatever we just discussed, let's apply it in a practice question. When you do these practice questions, these numericals, you understand in a better manner. Let's look at it. Now, practice question number 1. Mr. A has following incomes for the year. Employment income 30,000, trading income 20,000, property income 10,000. We have to calculate the tax payable. Believe me, very easy. Just listen to me. Now what I am doing is, we are making income tax return. We are making the income tax return. Okay. Employment, trading and property income. All of these three incomes are non-saving income. There is no interest income. There is no dividend income. Just listen to me. Employment income, how much? Employment income, 30,000. Goes in the head of non-saving. Trading income, how much? 20,000. Goes in the head of non-saving. Done. Third is property income. There is no interest income, there is no dividend income. Property income 10,000. See, trading income means that either we are a sole trader or partner. If it would be a company, it would be dividend income. That's a separate thing. Currently, this individual has employment income. Trading income is business income like sole trader activity. And the property income, he is getting these three incomes. Done. Very easy, very easy. Just look at it. Add up all of them. Add up all of them. So you get your total income. 30, 20 and 10. 60,000. Deduct your personal allowance from it. Your personal allowance is 12570. See, that is provided by the tax department. 12570. 12570. Here you go. This is your taxable income. How much? Taxable income. 60,000 minus 12570. So it's 47,430. Done. Let's apply tax on it. Let's apply tax on it. Now, on first 37,700, the rate of tax is 20%. See, we studied it. Till first 37,700, it's 20%. Basic rate band, the initial. These are the bands, the slots, slices. First 37,700 at 20%. So it is 7540. Done. Then 47430. This balance will get taxed at 40%. The band gets changed. See, these are slices. First 37,700 is basic rate band. It's not like that whole income will be taxed at single rate. First band, then the second band. So 47430 minus 37,700. It's 9730. 40%. So it is 3892. See the magic? The question is done. It's done. 11432. Is it difficult? We just made an income tax return. We classified these incomes in the head of non-saving. There is no interest or dividend income. All three incomes were non-saving income. We deducted his personal allowance. We got the taxable income. On first 37,700, it's basic rate band. You charge 20% and then you charge 40%. Like, I believe that there is no reason why a student will face any difficulty. Like, what's the reason? Whatever incomes you earn during a tax year, you classify them in three heads: non-saving, saving, and dividend. All incomes are non-saving. It's a normal income head, except interest income and the dividend income. They have their own tax rates. We will study them in the next few classes. You deduct your personal allowance to get the value of taxable income. Basic rate band till 37,700, it's 20%. Then from 37,701 to 125,140, it's 40%. And then above that, it's 45%. It's that easy. Then you classify the income. You add them up to arrive at the value of total income. You deduct personal allowance to get the taxable income and you simply charge the tax. I don't see any reason that someone may face it difficult. 37,700 basic rate band 20%. Then you take the difference, 37,700 minus 47,430. The additional portion goes in the higher rate band. One more practice question. Sir, it's very easy. Why one more? One more and then one more. Practice will make the things more clear for you. Let's look at it. Now, Mr. A has following incomes for the year: employment income 50,000, property income 25,000, and trading income 5,000. We have to calculate our tax payable. Okay, we have to calculate our tax payable. Let's look at it. So now we are making the income tax return. We are making the income tax return. These three incomes are non-saving because there is no interest income or dividend income. Non-saving income, employment 50,000, property 25,000, and we have trading 5,000. Okay, the three incomes. Trading 5,000. So 50, 25 and 5, we add up all of them to arrive at the value of total income. So that gives us 80,000 in total. You deduct your personal allowance. This personal allowance is 12,000 570. That gives you the value of taxable income. Like you add the incomes, you arrive at the total income, you deduct personal allowance. That's a fixed value given by the tax department. You arrive at the value of taxable income. I don't see anything difficult in it. It's 67,430. You will charge tax on it. Tax on first 37,700, it's 20%, 7540. On first 37,700, the basic rate band, it's 20%. Then how much is the remaining? Your taxable income was 67,430. Just take the difference. It's higher rate band on which you charge 40%. 67430 minus 37,700, it's 29,730. You will charge 40% tax on it, 11,892. You add 7540 into it, so it's 19,432 as your final tax. Like, what's difficult in it? There were three incomes: employment, property, and trading. All were non-saving because there was no interest income or dividend income in the question. There was no interest income or dividend income in the question. Okay. All three were non-saving. That gives you total income. You deduct your personal allowance to get the value of taxable income. On 37,700, which is your basic rate band, you charge 20%. Then on the difference, 37,700 minus 67,430, that difference, 29,730, you charge 40% and you get the final tax value. Are you getting it? I believe it's like very much simple. One more practice question. Here, what I want from you guys is that you should pause the recording. Pause the recording and try this question on your own. I'm doing it as part of the class, but obviously you can pause the recording and first try it on your own so that you also have the practice. And if you have anything in your mind that comes up, then you can continue the recording. Let's look at it. Practice question 3. Mr. A has following incomes for the year. Employment income 40,000, property income 35, trading income 9,000. We have to do the tax payable. Again, just a routine question. So we are doing his income tax return. Just listen to it carefully. We are doing his income tax return. All three incomes are non-saving. Sir, how do you know this? Can you see any interest income? Can you see any dividend income? No, so all three are non-saving. Non-saving means normal income, all incomes except interest and dividend. Here you go, employment income, how much? The employment income is 40,000. Done. Then you have rental income, the property income. So your property income is 35,000. Employment is 40, property income is 35. Then you have trading income, 9,000. Just put all three incomes, add them up, you will get total income 40, 35 and 9, 84,000. Done. Let's deduct personal allowance from it. 12570. This will be available in the examination in the tax rate sheet. So nothing to worry if you don't remember the values. You will get the value of your taxable income. So your taxable income will be 84,000 minus 12570. So that gives you 71,430. Done? Let's charge tax on it. On 37,700, you will charge 20%. So that gives you 7540. Then on the balance, you will charge 40%. So 71430 minus 37,700, it's 33,730. The rate of tax is 40%. That gives us 13492. You add them up to arrive at the value of tax. 21032. So if you look at the question still now, I believe that there is no reason, there is no slightest reason even that you may feel it difficult. You were given with the data of income. There is no interest income and dividend income. We haven't studied them yet. Okay. All three of the incomes were non-saving. Employment, property and trading income. All three incomes provided were non-saving income. You add them up, total income, you deduct the personal allowance to get the value of taxable income. Personal allowance value will be given in the examination. These are the tax bands. On first 37,700, it's always 20%. Then on the excess, you charge 40%. That gives you the final tax value. Done. So if you look at it, we have just started the basic income tax return. Whatever incomes an individual earns during a tax year, you classify them in non-saving, saving and dividend. Non-saving, all incomes are non-saving. All incomes are non-saving. We call it as normal income, except interest income and dividend income, which have their own separate tax rates. Okay. Personal allowance, tax bands, you just did 3 practice questions. Now let's move forward and let's introduce one more small concept. We introduce a small concept, we do practice question. A small concept, a practice question, and so on we'll move. So now we are looking at one more small concept, and that is a real estate investment trust. What is a real estate investment trust? How it is taxed? What is its concept? Let's talk on that, and then we'll do 3 more practice questions. Okay, so let's talk about real estate investment trust now. Okay, so real estate investment trust is a mutual fund which raises investment from the public and then invest it in real estate or the property market. So basically it is a mutual fund in which people put in their money. It's a combined fund, and through that fund it invests in the real estate. It purchases properties. From those properties, a real estate investment trust will earn capital gains when it will purchase and sell the properties. And it also rents out those properties and it earns rental income from those properties. So what is a real estate investment trust? We are not talking about its tax implication currently. We are first understanding the concept. It is a mutual fund in which people put in their money. And against their money, we are not giving them the shareholding. We are not giving them the ownership of the fund. They are investing the money and they can take their money back anytime. If we make them the shareholders, we cannot return them their money easily because the capital redemption, the capital buyback of shareholders is not easy. This is a real estate investment trust in which they just put in their money in the mutual fund. We are not giving them the shares. Instead, we give them the units of the investment. We say that, okay, you have invested that much amount. You have these units. Whenever you want to redeem, just return the units and take your money back. So what is a real estate investment trust? It is a mutual fund in which people put their money, or you can say it's a combined fund or a collective fund. This fund then invests that amount into real estate or what we call as the property market, buys and sell the properties. From those properties, it will earn capital gains and the rental income. In normal life, we see mutual funds for stock market also. Stock market mutual funds are the combined funds which then invest in the shares of the companies. But real estate investment trust is a mutual fund which is not investing in the shares and stock market. It is investing in the real estate market or the property market. Okay. Real estate investment trust earns through rental income. Obviously, whatever properties it purchases, it can let it out, it can rent it out, or it earns from capital gains when it is doing buying and selling of the property. Whatever it earns, it distributes its income to the investors. So let me repeat the concept. See, it's very important that when we are talking the concept, you listen to it carefully. Then practice questions are just the numerical, the application aspect. What is a real estate investment trust? It's a mutual fund, a pool of fund in which people put their money in. So now someone will say that, sir, when we purchase the shares, we are also putting the money. See, shareholding is ownership. In real estate investment trust, we are not making you the owner. You invested the funds, we give you the units of the fund. Okay, you have these many units, 10,000 units, 5,000 units, 8,000 units, and every unit has a certain value. Whenever you want to return your investment, you can sell the units in market also, or you can come to us. We will take back those units and we will give you your money. This is how the real estate investment trust works. So it's a mutual fund, a pool of fund, which raises the investment from the public, and then it invests those funds in the real estate or the property market. Obviously, there are rules for redemption that, okay, you have to tell these many days before, or there is a certain duration, or whatever that practical aspect works. But the concept is that it's a mutual fund, public put in the money, a lot of people, it's a pool of fund, a big pool, and then they purchase the properties, they sell them, they earn the rental incomes, and at the end of the year, whatever they earn, they distribute it to the investors. Now, one important question. Sir, why to invest in a real estate investment trust? Why not directly buy a property? You all know properties are expensive. You cannot buy a big real estate if you have very limited investment. So we invest in real estate investment trusts like $1,000, $500, maybe someone has £1,500, someone has £800, whatever small amounts we have. We put in the real estate investment trust maybe 50,000 investors, a big pool, and then REIT is managed by experts. Okay, the risk is getting pooled because they invest in a lot of properties. An investor invests in REIT rather than purchasing real estate directly because it reduces the risk. These are the experts, and the risk is getting pooled because there are a lot of investors. Now, from the tax perspective, whatever a real estate investment trust will earn, at the end of the year, they will distribute a dividend. They will distribute a dividend to its investors. See, despite that it is a dividend in the real terms, we call it as a dividend. But from tax purposes, it is not taxed as a dividend income. Rather, it is taxed as a non-saving income. See, it is distributed as a dividend. Now, in the tax return, dividend has its own head. In the tax return, the dividend has its own head. The tax department is not taxing real estate investment trust in dividend. Rather, they are taxing it in non-saving income because they say that real estate investment trust is earning from the property market. Its characteristic is of property income because it invests in the real estate, it invests in the property market. So despite that, in reality, whatever you will be getting in your bank account is a dividend income. Your bank account will receive $10,000 dividend income. But if that is from a real estate investment trust, it will be taxed as a non-saving income. Because property income, rental income is a non-saving income. It is not a dividend from a company that we tax it in the head of dividend. Second, it will be taxed on receipt basis. See, for tax purposes, an income can be taxed on receipt basis. That in whatever tax year you actually receive it, then only it will be subject to tax. Like for example, if you receive it in 25-26, then only it will be subject to tax. And there is one concept called as accrual basis, that even though you haven't received it, but for example, every year you get a certain amount. So we say that, okay, it's an accrual of that amount. You will get it later. So that is accrual basis. Even though you haven't received it, you will be subject to tax. That is accrual basis. But for real estate investment trust, it's receipt basis, that in the tax year in which you actually receive, the amount will come in your bank account, then only it will be subject to tax. Okay, there will be incomes we will be talking in the future of this course when we'll be talking about accrual basis. Withholding tax is the new concept for you guys. Withholding tax means tax deducted at source is 20%. Now, what do you mean by this? If a real estate investment trust is paying you £100 dividend, take an example, if they are paying you £100, 20% of it, £20, they will pay it to the tax department and they will only give you £80. Why, sir? They will pay this £20 tax on your behalf as an advance tax. You can adjust it in your income tax return at the end of the year, we will see it. But this 20% is withholding tax or tax deducted at source, or in very easy words, advance tax. Whenever a real estate investment trust will be paying you a dividend, they will deduct 20% and give it to the tax department as an advance tax on your name. Sir, I'm feeling it as difficult. Don't worry. Don't worry. It's just the first class. We have just started it. I will repeat the things again. So don't worry. What is a real estate investment trust? It is a mutual fund. It is a pool of fund in which a lot of people put their money. They put their money. We give them the units. Like you can say them like shareholding. We are giving them the units. But it's not shareholding in actual. Because if we call it as shareholding, they will become owners. These units are their proportion of investment, that okay, you invested this, but it's not shareholding by law, because otherwise they would become owners. They are not the owners. They've just put in the money in the fund. Whenever they want to return their money, they will give us the unit and we will give them their money and they are free to. Now, in this pool of fund, in this mutual fund, a lot of people put in their money. The real estate investment trust, which is a fund managed by expert, they will invest it in the property market, real estate market, earn the capital gains like buying and selling of the properties, earn the rental incomes. Now, whatever they earn, obviously, they will take out their salaries and then they distribute the dividend. They give it to the investors. Now, the amount coming into your account will be named as dividend. You will be getting a real estate investment trust. Even in the exam question, it will be referred as real estate investment trust dividend. But for the tax purpose, you will not tax it in the head of dividend. Why? Because the tax department says that it is like property income, it is like rental income, because real estate investment trust is earning from the property market. So that's why it will be taxed like property income in the head of non-saving income. It will be taxed on receipt basis. The tax year in which you actually receive it, in that tax year only it will be subject to tax. Like for example, it is announced but you haven't received it, there is no tax on it. In the year in which you actually receive it, in that tax year only it will be subject to tax. And advance tax is 20%. Whenever a REIT is paying you an amount, they will deduct 20% from it. Now, just have some patience. Let's do 3 practice questions. What is withholding tax? What's receipt basis? How we do it? Let's look at it. Now, practice question number 4. Mr. A has following incomes for the year. Trading income is 52,000. Pension income is 2,000. Real estate investment trust dividend. See, the name written is dividend. But we will not tax it as a dividend. We will tax it as a non-saving income. Because it is like property income, it is like rental income, because real estate investment trust invest in the property market. Now this 9,000 is a net amount, always remember. 20% is the withholding tax. What you need to understand is, whatever you received is 80%. Whatever you received is 80%. Whatever you received is 80%. Because when a REIT paid you an amount, they gave you 9,000. So in reality, the amount was not 9,000. It's 80%. Because 20% went to tax department. So if you look at the gross amount of this dividend, it's 11,250 in reality. In reality, it was 11,250. 9,000, 80% was given to you and 20% was given to the tax department, your advanced tax. Just listen to me how it works. Let me teach you. You make your income tax return. You make your income tax return. All three incomes are non-saving. There is no interest income or dividend income. Trading income, how much? Trading income is 52,000. Pension income is 2,000. Pension income is 2,000. And real estate investment trust, it is 9,000, which you received, divided by 80%, multiplied by 100%. You received 9,000. So the gross amount is 11,250. You received 80%. The gross amount is 11,250. That gives us the total income. 52 plus 2, 54 plus 11,250. So it is 65,250. Just listen to me carefully. We will deduct the personal allowance from it. 12,570. 12,570 from it. That gives you the taxable income. That gives you the taxable income. So what is your taxable income? 65,250 minus 12,570. So it's 5,2,680. Done? Just listen to me carefully. Now I am charging tax on it. On first 37,700, you charge 20%. 7,540. Done? How much is remaining? How much is remaining? Let's look at it. 5,2,680 minus 37,700. So the remaining amount is 14,980. 40%. 5,992. So now your tax is 1,3,532. But wait a minute. We paid some tax in advance. See, I received 9,000. The total amount was 11,250. While making the tax return, I used the total amount. So that first I get the total tax. Just take an example. You go to a hotel. You pay some deposit. You pay some advance. Now when you are checking out from a hotel, what you will do? First you will calculate your total bill. You include total incomes. You calculate your total bill. Then comes the issue that, oh, I paid you some advance. I paid you some advance. Gross amount was 11,250. What we received was 9,000. So it's 2,250. You can take the difference or you can apply 20% also. So tax credit, what we paid in advance, is 2,250. See, this value is called as tax liability. What we paid in advance, adjust that, and the remaining is called as tax payable, 11,282. Sir, will you repeat it again? Yes. How is it possible that I will not repeat? By now you should know me. Trading income is a simple non-saving income. Pension income is a simple non-saving income. Real estate investment trust is a mutual fund in which a lot of people put in their money. They invest in the real estate market. They earn from that through the capital gains because they buy and sell real estate and the rental income. Whatever they earn, they distribute it to their investors in form of dividend. Oh, sir, dividend. Is it head of dividend income? No. Despite that real estate investment trust is paying a dividend, the word used is dividend. By law, it is called as dividend. But for tax purpose, it is taxed in the head of non-saving, not as dividend income. It is taxed in the head of non-saving because the tax department treats it like a normal property income. Real estate investment trust taxed on receipt basis. When you actually receive it, in the tax year in which you receive it, in that tax year only, you will include it in the tax return. If it is announced but not received, no tax. When you actually receive it. 20% advance tax, what we call as withholding tax or tax deducted at source. 20% advance tax, tax deducted at source. Sir, is there withholding tax on any other incomes? Yes, there is withholding. We will study them. We have introduced the first withholding income, that is REIT. So 20% is withheld. So whatever you got is 80%, divide by 80, multiply by 100, you gross it up. First, you calculate your total tax bill. 52, 2 and 11 to 50. You add them up, you get the value of total income. You deduct the personal allowance to get the value of taxable income. On 37,700, it's 20%. On the remaining, it's 40%. You get your tax liability. Whatever advance tax was, you grossed up 9,000 to 11,250. The difference that you claim as tax credit and you get your final tax payable. Okay, one more question. Okay, no hurry. Let's look at it. Mr. A has following incomes for the year. Trading income 14,000. Pension income 25,000. Real estate investment trust 11,000. So this amount is net. Withholding tax is 20%. Withholding tax is 20%. Let's look at it. We are making income tax return. It's non-saving income. All three incomes are non-saving. Trading income, how much? 14,000. Pension income, 25,000. And then comes real estate investment trust. How much? 11,000. But on real estate investment trust, there is withholding tax. So divided by 80%, multiplied by 100%. Whatever you are getting is 80%. Whatever you are getting is 80%. So the gross value is 13750. You add up all of them. You get your total income. 14,000, 25,000 and 13750. So it's 52750. You deduct your personal allowance. So the personal allowance is 12570. You will get your taxable income. I believe that's very much routine. We have done it multiple times. So minus 12570, it's 40180. On 37,700, it's 20%. So that gives you 7540. Then what is remaining? 40180. On the difference, you will charge 40%. That's very much routine. 2480. You charge 40% on it. 992. See, till now it's very much routine. So your tax liability is 8532. Let's deduct the advance tax which we have already paid. Let's deduct the advance tax which we have already paid. Okay, that was 2750. Difference of 13750 and 11,000. So that gives me the tax payable. Done. 5782. So if you look at it carefully, I believe that it's just simple. We put the incomes, real estate investment trust, we gross it up. Okay, we get the total income, we adjust the personal allowance, we arrive at the value of taxable income. On 37,700, which is the basic rate band, you charge 20%. On the remaining, you simply charge 40%. Okay. On the balance, you charge 40%. You get the tax liability. Okay. Then the tax credit, since you grossed it up, and you get the final tax payable value. Let's repeat the things again. Let's repeat. What's an income tax return? You put up all the incomes which you earn during a tax year. From 6th April to 5th April, whatever you earn, put in the tax return. Non-saving normal income, saving incomes is interest income, and dividend income is what you get from the companies, the profit distributions. You add up the incomes, you get the value of total income, you adjust your personal allowance to get the value of taxable income. These are the tax bands. They will be available in the examination: basic rate band, higher rate band, and additional rate band. You have the personal allowance, you know the tax year. We did 3 basic practice questions first of all. Then real estate investment trust, a mutual fund, a pool of fund, lot of people putting in their money. Then the fund invest in the real estate or the property market, earns through the rental incomes or the capital gains, distribute the dividends to its investors, but it is not taxed as dividend income, it is taxed as a non-saving income, because tax department says that it's a property income in our view. It's not a normal profit distribution. It's like a property income. It's not like what you're getting from a normal company. Taxed on receipt basis, the tax year in which you actually get it, in that tax year only it will be taxed. And 20% tax is deducted at source, that's paid at source. There are a lot of incomes on which tax department takes advanced tax. Now you must be saying that why do tax department take? Obviously they want to manage their cash flow, so on some incomes they take advanced tax rather than waiting for the entire tax year. One last practice question for this. I want you all that you should pause the class, try it on your own, and then watch the lecture. Okay. Obviously I'm doing it as part of the continuing lecture, but you can pause it and try it first. Mr. A has following incomes for the year: trading income 25,000, pension income 18,000, real estate investment trust dividend 6,000. Obviously it's net. 20% is the withhold, advanced tax, withhold, tax deducted at source. Let's look at it. It must be now very much routine. We are making an income tax return. Okay. So it's non-saving income. There is no interest income or dividend. Sir, there is dividend, real estate investment trust dividend. But it's not treated as a dividend for tax purpose. They treat it as a non-saving income. So the trading income is 25,000. Pension income is 18,000. Trading income 25. Pension income 18. Then we have real estate investment trust 6,000. It's net, we need to gross it up. It's net, we need to gross it up. So what's the gross amount? The actual income, that's 7,500. Okay. You add them up to arrive at the value of total income. 25 plus 18 plus 7,500. So it's 50,500 as your total income. Done? Let's deduct your personal allowance. It's 12570. And here you go, you get the value of taxable income. That's very much routine, I believe. You have done it multiple times. It's 37930. So we charge tax on it. Tax on first 37,700, it's 20%. That gives us 7540. And on the balance, what's the balance? 37930 minus 37,700, it's 230. You charge 40% on it. So it's 92. 7540 and 92. It's 7632. That is your tax liability. Now, what was the advance tax which we paid? Let's look at it. We paid some advance tax also. If you remember, Real Estate Investment Trust, we grossed it up. 1,500, 7,500 and 6,000, the difference. So that gives us the final tax payable, and that is 6132. So if you look at these practice questions, like there is no interest income or dividend income in the question. So whatever we are getting is non-saving income only. You just classify the income, deduct the personal allowance, get the taxable income. Personal allowance will be available in the question. Tax bands will be available in the question. You just need to ensure that you are multiplying the right values. That is what I am just expecting from you. And if you can't do that also, I have no words. Okay. If you are getting real estate investment trust, 20% is the withhold. Tax deducted at source. So whatever you are getting is 80%. Gross it up. Gross it up. Divide by 18,200. Look at your total incomes and then calculate your tax. Whatever you have paid in advance, you can adjust it as a tax credit and you get the tax payable. So in our today's class, we introduced the income tax return and we talked about real estate investment trust. Sir, one quick question. You are teaching it us on this by writing it. Our exam is on computer-based platform. When you will teach us that? Patience. First, let me teach you the text. Then I will teach you the exam platform also. I will be doing a lot of complete exam papers on the exam platform also. That's a separate thing. But first, study text. If I mix up both of the things, you will get confused. Okay. So if I sum up the today's class, we started our discussion with basic income tax return of individuals. Whatever income an individual earns during a tax year, it is divided in three heads: non-saving, saving, and dividend. Non-saving is normal income. It includes everything except interest income, which has its own head because it has separate tax rates, and dividend. We will study, like in the next class, we'll talk about dividend income. Its tax rates. We'll talk about everything. But believe me, your patience is most important. If you will rush, you will get confused. You classify the incomes, you deduct the personal allowance. It's a fixed value provided by tax department. You use the tax bands to calculate the taxes. Basic rate band 37,700, higher rate band from 37,701 to 125,140, and then comes the additional rate band. Tax year is from 6th April to 5th April. We did 3 basic practice questions first. Then we introduce the concept of real estate investment trust, a mutual fund, a pool of fund, invest in the real estate market, you get the dividend, but it's not taxed as dividend income. It is taxed as non-saving income because it earns like the property income. It is earned like real estate income. Taxed on receipt basis, advanced tax is 20%. How you do the gross up, adjustment of tax credit, I believe it's an easy one. So with this, first class or first chapter is done. Basic tax return and REIT. We will continue adding up the topics in it, and so on we will progress. So in the next class, we'll move forward and we'll talk about dividend income, and then we'll talk about interest income and a lot of small adjustments. Then obviously employment income, trading income, property income are detailed chapters which we'll be talking on. So the only important thing throughout this journey is your patience. That obviously require trust on me. And you can have trust because I've been teaching this paper for like more than a decade, more than 50 nationwide position holder students, more than 15,000 students I have taught. So you can have trust, but with that trust, keep patience, concentrate on it, and everything will be crystal clear. Okay, so before the next class, obviously all of these notes are available on PDF form. I've uploaded them on the platform. You can print them out. Before the next class, revise it, and in the next class, we'll be moving forward. If you have any query, you all have my direct WhatsApp number to ask. Okay, so thank you everyone, and hope to see you all in the next class.